let's get this thing started. So first of all, thank you everybody for joining us. I think we've got it was around 27 when I checked a second ago, attendees here. Really glad everyone's able to join us, and thank you so much to our panelists. This is the second one of these interactive brainstorm sessions we've done. We did one last week on the future of personal tokens, and that is now, you can watch the recording online. It's linked, we'll repost it, but just check out at IDOVC. And there's also a summary of some of the key takeaways from that session. We'll be doing the same for this one as well. So first I want to introduce and thank our, I don't want to call them panelists really, because they're actually going to be helping to lead the conversation with us. So first it's myself and Gavin, both from IDEO Collab. We're on IDEO Collab Ventures team, and we're really excited about flash loans. We've been spending a lot of time thinking about them, talking about them, and we wanted to introduce our collaborators here, Tina Zen, Max Wolf, and Camilla Russo. I will let them give brief introductions for themselves as well, and then we'll kind of dive in here. Tina, do you want to give us your quick overview, particularly relative to Honey Lemon Market?
Sure. I'm Tina. You may know me as the WTF Tina for putting together the DeFi.WTF and co-hosting Macro.WTF. And in the past, I've been more of a hackathon tourist, bounty hunting for and had co-created LSI and a variety of other interesting or Liquid 3D small experimentations. And my main focus in the past 2 years, in fact, I've been researching a bit on the economic implications of hash rate and staking derivatives. So what I'm working on right now is Honey Lemon Market, which is currently gives you the best price for the different, essentially the price curve for different maturities in the mining world, how they're traded, and working on a marketplace and basically a hash rate token, that hash rate payoff token that streams payoff to the token holder. I think that would be a cool risk that we introduced to the Ethereum DeFi space.
Looking forward to playing with that. Max.
I'm Max. I'm currently an engineer at Compound, but I formerly worked on a project called Marble, which was also kind of in the DeFi lending smart contract space. And the reason I'm probably on this panel is because we technically launched the first flash loans on Ethereum, which is pretty cool. Back in the day when it was like mid 2018 when this came out, we launched it kind of as a tool for DEX arbitrage bots, in particular our own DEX bot, to basically, put two DEX orders together and profit without any risk. And it was a pretty interesting era. Basically, everyone started using this contract we put out for exactly the same thing. Our stuff started to get front run by other people. And we ultimately decided, like, this is not real. It's not a real business. You're not going to be able to lend money for zero time for money. So we stopped doing it. But people have been very creative with it since then. So here to talk a little bit about that.
Very cool. Thanks, Max. Hi, Cami.
Hey. So I'm Camila Russo, also known as Cami. I'm a financial journalist, the founder of The Defiant, almost daily newsletter focusing on decentralized finance. I'm also about to launch the first book on the history of Ethereum called The Infinite Machine, which you can already pre-order. And previously to going full crypto, I was a journalist at Bloomberg News for 8 years covering markets. And yeah, of course, I've been covering flash loans closely, looking at all the possibilities they open up for the Defiant. So yeah, really interested to see where this conversation goes.
Awesome, thanks, Cami. And for anybody who hasn't yet signed up for Camilla's newsletter, The Defiant, I highly recommend it. It is one of the best ways to stay on top of the latest happenings in DeFi. And it's not just kind of repeating press releases, it's really thoughtful coverage and analysis. So everyone sign up for that.
Yay.
Yeah. So just a little bit about IDEO Collab before we dive in. So I think a lot of the folks on the call are familiar with us. We're part of IDEO, which is a global design firm with about 700 designers globally that help popularize the concept of human-centered design and design thinking. We've had this small team within it called IDEO Collab that's been working in the blockchain and crypto space since 2015. And we've worked with a pretty wide range of companies and projects in the space. And in 2018, we launched a venture fund to be able to invest in pre-seed and seed stage startups that are building cool new products and protocols related to distributed web technologies. So last year in 2019, we also launched a startup studio program to help support even more startups and entrepreneurs than we can touch directly with our fund. And we I think, are programming interacted with about 200 plus startups during the last 6 months of the year. And in 2020, we're taking it even further and really starting to emphasize some of these more virtual interactive programs to be able to get folks beyond San Francisco and really around the world. So today's topic is flash loans. And so I think most people on the call are familiar with them, but just to get us started, I want to give a little explanation of a way that you can think about flash loans. So hopefully this will work. And sound is not working. Okay, hang on 1 second here. Tested this last night and it was working. Testing it now, of course.
Live.
Wait.
The Marvel's Agents of S.H.I.E.L.D. Classified Secret Warriors profile. Inhuman Debrief. Elena Yo-Yo Rodriguez.
How do your powers work?
That's terrible. As far as she can go in one heartbeat.
Yo nunca usaría mis bendiciones para cometer un pecado. Son un regalo de Dios.
Okay, so that was kind of like how I initially thought of flash loans, right? It's this Marvel superhero Yo-Yo is able to go as far as she can and really, really fast within the length of one heartbeat. And that's a lot like what flash loans are, right? It allows you to take out these uncollateralized loans as long as you adhere to this one very, very restrictive covenant, which is the loan must be repaid within the same transaction that it is borrowed. And if it does not get repaid, you can try doing all sorts of crazy things. If it doesn't get repaid, then the whole thing reverts. And this is something that has only been possible on a blockchain. We've kind of done some discussion around it. I don't really think there's any way that you can even really approximate this in the legacy financial system if you're going between multiple venues, multiple parties. It's just a really unique feature that we have in this space. And so that unique feature has a lot of pros and also some cons. And so I'm gonna turn it over now to Gavin to kind of kick off the conversation around what we see as being exciting about this concept.
Yeah, here. So the format of this conversation today, because the interactive piece is kind of important, is we're gonna do a little bit of AMA with Cami, Max, and Tina. So maybe around 15 minutes or so, and then we'll make it a little bit more interactive, hopping into Figma file, and we'll be doing a few things like creative tensions. So everybody who's on the call right now, we'll be getting into that in a little bit later. But let's start with a couple of questions and just kind of open it up here. So one of the first ones, since you guys are all deep in this in very different ways, it's kind of like, what are the most interesting either immediate or long-term effects that you think flash loans are going to have on just finance in general? It could be DeFi, or it can be maybe porting people into the space. Just how do you think about it right now in terms of what's the most interesting aspect?
To me, I think it's been amazing to see that flash loans kind of enable people to do these really sophisticated financial strategies without having to be a big investor in the first place. I think in the past, all these arbitrage opportunities were restricted to, and arbitrage opportunities and the big returns that come with them were restricted to a small set of investors who had the capital to take on all this risk. But now with flash loans, granted they're very technical and not everyone can access them, but potentially because they don't require any initial capital, it allows anyone to get the return from these riskier strategies. So I think it goes into the same line of what I think is so interesting in DeFi, which is it lowers the barriers of entry to finance. And I think that's super exciting.
Haseeb from Dragonfly had a really great post. It was, I think it was last week, but it was kind of mentioning exactly what you just said of it's like before you had people with the capital who didn't have access to the technical expertise, but the people with technical expertise never had the capital to do it, and it kind of merges these worlds, right. And suddenly you have this ability. Max or Tina?
Yeah, I guess I'll go next. I think that's a good point. So I'll make a different point because I don't want to just talk about the same thing. I think there's a lot of interesting smart contract stuff that makes that's been made possible with this. So for example, so something like a Instadot bridge, or if you guys saw the 1-inch leverage aggregator that came out of ETH Denver a few weeks ago. Mm-hmm. What's really cool is that you can connect a lot of different protocols together in the same transaction without them needing to like know about each other or coordinate with each other. So I mean, another good example is just the DYDX atomic margin trade situation, where they use a DEX to basically get you better leverage in a single transaction without having to do this crazy looping thing you have to do in other lending protocols. So these are really cool things that you can now do where the designer of the protocol, so for example, a Compound or some other lending protocol, doesn't have to know anything about how DEXs work, doesn't have to build that into their smart contracts or anything else in order for someone to take advantage of using a DEX in the middle of a Compound transaction or something else. I mean, apart from that, just like building on what you said is like, stronger liquidations, stronger arbitrage, now that it's a broader market that anyone could be a part of, and the cost of entering is much lower. Obviously, smart contract hacks is like the thing that's gotten a lot of press recently, but I feel like everyone probably has heard enough of that at this point.
Most definitely.
Cool. I guess I'll also add on it, and I think those are great points. I think flash loans is amazing that it accelerates our march towards efficient market, in essentially kind of democratizing the ARB opportunities for anyone in the world. I think Haseeb's piece is an absolutely spot on that point. But what I want to also point out, what gets me excited is that I'm seeing this new future, or a norm of essentially that will probably be we're going to see around the horizon is the DeFi structured products being offered by trading services that exploits outside arbitrage opportunities through the flash loans and runs essentially private pools or aligns with mining pools to ensure transactions won't be reordered or will be reordered. Okay, that's a long-winded way of saying miners will come into play sooner than we have expected, and that would be taken as a new normal.
Oh, absolutely. Makes complete sense that they're the ones who have the kind of the last side of these things. I guess like kind of on that one, it's like then on which protocols do you guys think are most at risk with these things? Kind of where we are today in terms of flash loan exploitation, and why?
I'll jump on this one. I think probably the way I would think about it is like protocols that make permanent changes to users' balances and stuff like that based on stuff that can be manipulated in a single block. So, the obvious ones are lending protocols that use DEXs as oracles. I think Nuo still uses Kyber. So that might be something to be worried about. In governance, I don't think anybody is that at risk right now on the governance side. MakerDAO, I think, implemented a delay that somewhat addresses this problem. That said, there's probably a bunch of ways to grief other protocols at the very least, just make things annoying and difficult to understand the on-chain information. So one thing I could think of was a lot of these, there's a lot of like the yield aggregator protocols where I'm assuming they check on-chain what the interest rates are before they switch your money over. Like that's a pretty easy thing to grief, as that's basically another on-chain oracle, much less disastrous than on-chain lending oracles, but yeah.
Awesome. Tina or Cami, anything on that one in terms of protocols at risk in your opinion, or projects?
Well, I guess one of the temporary problem that we're seeing is essentially the pools with low liquidity, the asset with low liquidity, and using certain oracles that didn't use measures such as time-weighted average would be exposed a temporary, I think, attack vector. But I think that gap is going to be closed very soon because the entire space is coordinated in an uncoordinated way out of thanks to actually this reminder of risk from the BZX attack, the lesson learned. I think the entire industry has learned very fast. So that gap is going to be closed very soon.
Yeah, I think one of our other participants online mentioned also, you need to use this time-weighted average price at TWAP. This is something that legacy finance has learned. It sounds like maybe Nuo hasn't learned this yet, but anybody using instant price oracle, that's Richard Hart. Yep, thanks, Richard. That there's going to be problems taking that instantaneous price. So basically, don't do that.
We as humans have this just tendency to relearn history again and again and again. Pricing at a point. All right.
So I guess like the only, because I think the big lesson learned here was not to use like the spot market price as an oracle, right? And also that in general liquidity is so low right now that it's just really easy to produce these large slippage. But I think maybe the governance side of it hasn't been really resolved. I think what Maker did with the delay probably solves their issue, but it does open kind of the flip side was now they have they can't react right away to other attacks. So I know they found kind of a way around it, but I don't know if like all of the governance attacks have been like fully considered at this point. So I think maybe that's something to watch out for.
I think one of the things though, we flash loans significantly reduced the cost of coordinating a governance attack. In the sense that it wasn't that the attack vector wasn't there, but because and it wasn't that Marble and the integrations wasn't possible in the past. It was the fact that it was the attack revealed it to literally everyone in the decentralized finance community that this can be used for a governance attack. And so that it actually lowers the cost of education of how to, if people try to do that. So for those who have not yet been build up defensibility against it, using various plays on time, then essentially that before that gap is closed, right now the cost of coordinating such attack is pretty low.
Right, and anyone can suddenly gain access to all the governance tokens they need to, vote that they should own all the collateral in the system or whatever they want. So
yeah, they're
pretty scary.
Yeah, there are very few protocols right now designed with this type of intercontract calling and time freezing ability. Most definitely.
Yeah, but the good thing is at least a few of the security auditors I know have long been setting up essentially dashboards monitoring this kind of activity. I guess like at least a few of them are already doing that so that they would know. I'm assuming quite a few of the projects internally must have been also monitoring such activities so that they will be alerted. I think that so everyone is catching up, which actually maybe we'll touch on later in the agenda, but I think it's actually really exciting that like if 2019 in my view was the year of chasing yield, 2020 is or curating yield. 2020 will be the year of curating risk, and the risk precisely composed of the smart contract risk and the economic risk. And I guess flash loan is kind of a bit of both. So yeah, so that's something that I think that level of awareness and also a lot more work for the people who are safeguarding the space.
Absolutely.
Yeah.
Go ahead.
I think we're about to transition to brainstorm, but I just want to quickly, Leighton from Pull Together shared a question. I don't know if folks have seen this tweet from Andre from to the Iron, but there's some crazy like flash loan based transaction that's gone here. It's been kind of going around on crypto Twitter. If you actually have figured out what the heck is happening here, either for our panelists or for anybody else, Leighton's posted the link in the chat a little ways up. But if anybody understands what the heck is going on there, that would be awesome to have explained on this.
Hop into Twitter or just if you raise your hand on the call and you want to explain, we'll dial you in. All right, as that's coming in, we're going to move over to Figma for kind of the next shared part here. We're going to do a little bit of a brainstorm. So let me share my screen here. Can everybody see everything here?
Mm-hmm.
Okay.
Yeah.
So, all right. So what we're going to do is open up something called Creative Tensions. And Ian should be opening up one of the first files here. If not, I'll do it here. So it's something basically where on a diagram, we create kind of two polar points. And what we're going to do is open this up to anybody who's on the call. So anybody who has this link to this Figma doc can hop in and participate in this. All right, looks like things are not opening. So let me open this. All right, so let me see if we can get this open. For some reason, this is all right. Sorry for the delay here. Okay, here we go. So for this first one, just to kind of give everybody who's on the line here an example of what's going on. So you see kind of the question of I am more of a cat person or a dog person. And so basically, these are all Post-its over here, where anybody who's in here, feel free to add your Twitter handle to one of these notes. And then if you place the note effectively anywhere on this spectrum, what it allows you to do, here I need to unlock these, I think. All right, can people move these? You might need to double click on the Post-it note itself. All right, at least we've got a little bit of these things moving around. All right, so if you drag these and put them anywhere on the on this spectrum, it'll basically give us an ability to kind of like call out and see where everybody is lining up on things. So folks, feel free to like move things around here, and then we'll open up another set of questions. So if you get the idea here, we'll kind of jump into the first one. All right, so everybody on the panel, like, you guys good with this? Everything makes sense?
Yep.
Okay, so let's hop to the
Just
first.
a really dumb question. Would you mind sending the link also to the Zoom call?
Yeah, it's in the Zoom chat. It's tinyurl.com/flashloans.
Oh, got it. Okay, cool.
All right, so I'll open up the first question here on the creative tension. So everybody who's in here playing around, let's hop to this next question, which is, flash loans are helpful or harmful? So feel free to dive into this one. Use the pink Post-it notes for this one, and feel free to add your Twitter handle, and we'll kind of get into this. You've got to double click on the pink as a heads up. Otherwise, you drag the whole thing around. And we have a possibility of breaking Figma here, so this is a total experiment. All right, I already see a couple showing up. Max, you're closer to, whoops. We have people waiting on.
Gotta recalibrate. Someone moved the graph around. All right. Oh, stop it.
All right. Yeah, everybody, please just double click on your Post-it note. Otherwise, everything will move around. All right. So Dan and Brock, you're way over here on the helpful side. You want to like give a little bit of commentary on this?
Yeah. Hang on. Actually, first I'm just going to try to move the notes, the block of notes off. Yeah. I mean, I think I agree with some of the other folks who made the comment that basically this is a great way to just battle test these protocols, right? Because you can't operate under the assumption that your protocol is safe unless somebody has access to enough money, because we're just in the very early stages here. And if this industry grows the way that I think most of us hope it will grow, then what we're playing with today is peanuts, and there are people with real serious amounts of capital who are going to come and use it to slam into these protocols. And so if you're relying on, oh, it's too expensive to make this attack, that's probably not going to be a good place to be for the security of these DeFi protocols.
Agree.
Where is everybody else here? I'll zoom in here. So Max, you're somewhere on the line here. You're a little bit closer to the medium here. Why so?
Yeah, well, I think there's a lot of things that flash loans can unlock as far as smart contract design, and that's super awesome. The negative, and as far as like just market efficiency, liquidations, that sort of thing. That said, yeah, I mean, I don't know, the cost of capital is never zero, right? Like, there is probably a downside, but in general, it's probably good.
This is interesting. We've literally got, I don't know if
no one seems to be to the right.
We've got one over
right
here.
side. Yeah. Or no, they just haven't moved it yet. But anybody who's like more towards the middle, if you want to raise your hand in Zoom, like not like physically raise your hand, there's like a raise hand button that you can like press, then Gavin can unmute you, and because we'd love to hear from some folks who are maybe helpful, but a little more concerned about the harm from these things. So like, you know, Jordan or Cam or Jay.
Because it looks like, Figma is kind of breaking on my end here. Can you guys see names anymore?
No, that's kind of disappeared for me too. So we may be busting Figma.
Yeah, this is.
Someone's messing with the with that grouping. Looks like.
Okay.
Please refrain from messing with the grouping.
All right. Because I was going to talk to Tara and Ian and Spencer Noon somewhere kind of in the middle here, but let's. I haven't seen a whole lot in the chat, so let's open up the next question here. So the next question is, here we go. Flash loan-based arbitrage, and this is the green ones here, but is it more sustainably lucrative, or does this just get competed to zero? So I think Tina's comment earlier about the miners and where things come in is kind of relevant here. So, you know, is this something that it's profitable now and it eventually gets to zero, or this is something that is sticks around for the long term?
Well, I think in general, all arbitrage opportunities tend to go away, but because this entire space is evolving so fast, so there are always new ways to arb. So that has been becoming created. And flash loans is just a facility that within certain constraints enables such activities. So I wouldn't consider it fundamentally changes how arbitrage and efficient market works. But I also do think that there will be more opportunities that come up very soon. And but then the ultimate winner, I think, needs to be able to control the power of TX reorganization. And it's likely that such a race, because regardless of which outsized profit opportunities exist, there could be a race to control such power. So basically, mempool access, it's going to be, you know, a no-brainer for anyone who does this. And also we may see alignment of join this alliance so that your transaction will not be reorganized, or pools in the dark, private pools that form around, in particular, just reorganizing transaction, because that profit is too big compared to just gas.
So yeah, I mean, that makes tons of sense. And it looks like, again, we've got this kind of patterning over here of getting competed to zero. So we've got Spencer and Dan and Jay over here. Matt, you're way on the end. If you want to pop a comment in, because it seems like you're furthest out over here on competed to zero, feel free to add any comments. And then
are we able to easily unmute him so you can just comment?
Let me see if I can do this. I've got the chat open. Let me see if I can unmute people. Dan, are you able to do that on your end? Because I'm sharing screen, so my stuff is.
Oh, good point. Let's get. It does not appear that I can unmute people.
All right, so I think I can unmute people.
All right.
Only when I'm not sharing here.
Okay. We found an edge case. We got a different person sharing and controlling next time.
Sorry, everybody. That would have been good to get you guys looped in. But if you want to pop into the chat, that'd be great, because we've got this clustering over here of getting competed to zero, and then a little bit in the middle here, and then Lawson and Richard are over here on the and really nobody with sustainably lucrative, which is kind of interesting.
I think, as with like all arbitrage, it can be lucrative, but the question is, will it be as lucrative as it is today? And I think it's pretty clear that it won't. I mean, just by the fact that if we all think DeFi will continue growing, that means it'll be more liquid, and that means there will be fewer arbitrage opportunities, and that moving or manipulating markets the way that they've been able to be manipulated right now will be a lot harder to do with just more liquid markets and more people trying to exploit every vulnerability. So I think maybe that's kind of a distinction. Like, it'll remain lucrative, but not like hugely lucrative.
All right, so we've got Tina right in the middle.
Yeah, because I do agree with Cami on that. So like, it's all relative in terms of a sustainably, how lucrative is it? Like, can we possibly exploit every single combination of flash loan exploits within one TX? Like, how, because there aren't that many available protocols out there with liquidity. And so the number of ways that, you know, we can come up with new variety probably is not that fast. So then people within certain known opportunities or means of leveraging flash loans for arbitrage, those will be raised down to zero more quickly.
Another way to think about this is just like in comparison to like other sorts of crypto arbitrage that we've seen. So like centralized exchange, market making and arbitrage, DEX arbitrage, like all of these things are still profitable for people that are willing to go to the very edge of being technically sophisticated and having really high performance on their trades. So for example, with DEXs, like the people that are making money aren't people, you know, running bots off their laptop. It's people that are, you know, running nodes in different parts of the world and like basically front running other people and then re-front running them once they've been front run with a higher gas cost and so on.
Mm-hmm.
And that's like, you know, it's technical work, and that's like at the edge of where people are willing to go. And I think there will still be an edge of how people are willing to use this technology to do that. And that'll be still profitable, but you know, over time, everything erodes as strategies become more widely known.
I agree.
We have an interesting question in here also in the chat from Travis, which is, can you use a flash loan to fight a flash loan? So for example, a flash loan depletes the ETH and Aave, and as a security mechanism, Aave lends ETH to its own reserve from DYDX. So like, great question. So let's hop into the last question here and unlock that, which is, you know, overall, just on a high level, what % of DeFi, you know, community deposits in aggregate do you guys think are at risk right now from exploits? And let's use orange on this one to orient ourselves.
Remember, just you gotta double click on the individual post that you want.
Yes, please don't. Yeah.
Richard, if you could please keep yours the same size as everybody else, that'd be great.
All right, so interesting. We don't have a ton in the middle right now. We've got a little bit close to. Matt again down near the edge. Tina, close to the middle again.
I'm just moving my cursor slowly.
Yeah.
Block time. So we've got a lot clustered into the edge. Go ahead, Dan. Sorry.
Yeah, I was gonna ask. You know, seeing some folks like JJ, some others who are down on the like very high percentage. You know, if we're talking about getting like anywhere above 50%, or actually probably even below that, like we have to be assuming that this can somehow be used to wreck compound and maker, right? Because if you're not, if at least one of those protocols is not vulnerable, there's no way you get to such a high percentage of the current deposits in DeFi. So I'm curious for the folks out there, like, is it your opinion that that compound or maker are in fact potentially vulnerable to exploits via flash loan? I guess, and then unfortunately, the not being able to unmute people is,
I know.
I'm not able to hear from them directly. But do we have? It looks like all the panelists are probably more on the relatively lower.
Yeah, it looks like
side.
everybody roughly over here.
But I am very curious. There are a few people who are again on the high side, and so I'm very curious to hear. So yeah, it looks like Matt Locker is suggesting, like, we just don't know. That we don't know what attacks are going to be possible, network attacks, upgrades that lead to vulnerabilities, people who hold keys change rates, things like that. So yeah, so and JJ also thinks that yes, compound maker collateral is at risk until we're certain that the attack area is closed. Yeah, I think it's fair. I guess for both of those, they're not represented like an on-chain price oracle, which makes it harder to manipulate in that way. But I guess you could, to the extent that an oracle is compromised, it makes taking advantage of a compromised oracle that much faster and easier. I was really pleased to see the maker finally close that vulnerability on the governance side, and at least putting in the 24-hour delay for changes, so it's not can't flash loan wreck the governance. But yeah.
So this has been great. I think we've got about 10 minutes left here. I think let's use this next place to, or this last couple of minutes here, because this is still a relatively new construct. So giving people giving anybody who's on the call or who tunes into this later some resources to kind of tap into. So in terms of opportunities and future use cases or places to kind of check things out, this next section that Ian just opened up is kind of opportunities. So if anybody who's on this call wants to, let's use this area to basically feel free to like go and snapshot like articles, headlines, things like that that are useful, and dump them into, just copy and paste them in here. And we can use this as kind of a repository for just resources for when people kind of show up. So things that you have, like either blog posts or repos or articles or conversations or links that you guys have found to be particularly useful, feel free to drop them in. Add them to these kind of like fake post-it notes on the right here, these digital post-its. Feel free to add your ideas over here and then drag them over, because they don't necessarily have to be an image. So if you have ideas, feel free to drag them in, and we can chat about some of these things in the next couple of minutes here before we wrap up at 10 o'clock. You know, so some of these ones that are initially dumped in are, you know, some of the sensationalist stuff are BZX loans signaling the end of DeFi. Like there's a lot of sensationalism that starts to show up when people don't understand the mechanic. and when it's something new. So it's both new, not understood, and lots of money moving around. So, one thing that I added this one for is just, don't listen to all the hype. It's kind of like dig into this thing to understand what the mechanism is, how it actually evolves, how it works. And so that's kind of my nudge to everybody who's just starting to dig into these things.
Can we actually have also a couple questions for other panelists?
Absolutely.
Curveballs. I actually really want to ask Max, as the author of Marble. When we saw it, when I first discovered it, I thought it was like absolutely brilliant. And then, and after the attack has came out, a few people who are actually not in the Ethereum space have mentioned on Twitter that they've written papers about similar concept on flash loans in like years ago. So, which actually comes, and when you actually read the papers they're referring to, it is a similar concept, but it wasn't implemented. And so basically, Max, would love to hear a bit of how you came up with Marble and implemented it, and why it didn't end up, I guess, stand alone as, such a great invention, interesting invention.
Yeah, so I was, to answer that, I'm not aware of any traditional finance stuff that's got anything to do with flash loans. That was not part of the process at all. The true answer is probably that, so I was working with another guy, Rich, and we were considering working at DYDX before we decided to do our own thing. And DYDX, I guess I got to give them credit, because although it wasn't really flash loans, it kind of was flash loans. Just like the way they built their exchange wrapper was like, basically inside their lending logic, they would say, okay, and now's the part where you get to do anything you want with a DEX. And then after that, we just have to make sure you're collateralized. And then that was how they got to do, basically use the amount that you would get from borrowing back as collateral through a DEX trade in their margin trade. So like, that's how you get to 3x in a single transaction when the collateral ratio is only 150%. So basically we decided, like, how can we break this out, which we thought was like one of the most interesting parts of it in the first place. Like, what does this look like as like a 50-line smart contract, right? And how can we make this useful for ourselves? And we were just like running a DEX bot at the time. So it was just kind of an inspiration, firstly, of looking at what they'd been working on, and also we were running a DEX bot, and like it's kind of cool to have like a on-chain provable property that you cannot lose money, right?
Yeah.
Yeah, so I guess it really comes from need rather than theory or research.
Yeah.
Wow. And also you also came up with Polaris, right? The TWAP
Yes.
kind of, was that also because you were doing arbitrage and you saw the attack vector that could come into play? Or like, was it related to Marble, like, or was it independent?
Yeah, so the idea was that we were going to launch a lending protocol where we would use Polaris as the oracle. We really wanted to use some kind of a decentralized oracle. Our whole idea was like that we would be a really decentralized lending protocol, but we like knew immediately that it was like totally a stupid idea to use Uniswap as like the only oracle. So we had to build like a layer around it. So yeah, also kind of inspired by direct need on that one. Unfortunately, never actually launched the lending protocol. Just launched all of these little doohickeys.
Why is that? Why did you, like, it would be cool to actually launch one with so many new features that are like kind of marginal improvement or significant improvement to what's going on here. But what other lending protocols had back in the time?
I mean, I would just say it was just kind of personal stuff between our the co-founders. We ended up splitting up as a team.
Oh, got it.
Yeah, so a common thing you hear about startups is the two ways you fail are the founders get in a disagreement or you run out of money. A little bit of both.
Yeah, I understand. So one thing, I think it's also like at the time, I think you guys tried to start with like flash loans as the initial purpose. And one of the things we see now is that in the case of like DYDX and Aave, right, they've got other uses for that capital. So it's not just waiting to be used for flash loans. It feels like this is the kind of thing you can bolt on to any liquidity pool, because as you mentioned, Max, it's pretty low risk. I don't know if it's no risk actually. A friend of ours, Austin Williams, who works with Open Zeppelin, published some stuff on GitHub about like different ways that you can implement flash loans, and the way that I think Aave and maybe DYDX as well have it implemented currently. Like there's certain like weird edge cases that he's theorized could potentially be exploited based on how it's checking for the loan repayment at the end, and basically a need in some ways to shut down other internal functions within the contract, or at least certain other internal functions within the contract, because there's something with like using them internally within the same contract versus externally, where there was potential exploit that he was pointing to with how some of them are implemented today. So I feel like in theory, these things should be like zero risk. We may have a little fine tuning to do on the exact implementation until I'm comfortable using that extreme of a statement.
Can I jump in here with one thing I saw in the comments a few minutes ago, which was just speculation about risk to maker governance, to compound in general. I just want to point out that if you guys check out the new governance stuff, shameless plug, in Compound, we actually look pretty closely at how flash loans can be used to impact proposals and impact governance. So, correct me if I'm wrong, but I think we did a pretty solid job of avoiding it. Basically, to make a proposal of like what to change in Compound, not only do you have to hold a certain amount of tokens, but you have to hold them all the way until that proposal is executed, and then anyone can cancel you at any moment that you don't have the right number of tokens. So instead of having to only hold your tokens for one block, you actually have to hold it for like 5 days or something, which is like, still, I mean, the risk is low because all it is proposing, but like it makes it a whole like different world of risk.
Yeah, so it's easier to get caught, right? If you have to hold the tokens after. Well,
you just can't use a flash loan anymore. Now you need to find 1% of all Compound tokens that you can borrow for a week or whatever. That's to propose. I mean, and to win an election, you need to outvote anyone else that has the tokens available. So it's something we actually did think about a lot in the process.
All right, you guys, a heads up, we're running into 10 o'clock here. This has been great. Here, I'll stop sharing here. But yeah, this has been really great. We'll have a lot of what we'll do is we'll kind of synthesize a lot of this content. We'll get a blog post out in the next week. But if there are any kind of closing comments from you guys, just about any of this, feel free to throw them out there before we kind of like exit and say our goodbyes.
I'm really excited for like the kind of new features or new ways of actually using flash loans for good. That people are using flash loans for providing other services for the participants in this. And case in point was like collateral swap was just the beginning. And we're also like, in creating a new construct, trying to use the good features of flash to lower the collateralization requirement for our use case. And I'm seeing a lot more that are spraying all over the places. So I would love to actually hear if anyone has seen any cool experimentation, innovative use of flash loans, yeah, that would be great. Either or share it in the Figma.
And what I'll suggest is actually let's take this to Twitter. So at IDWVC, there's a thread going with some of the questions that we talked about today. Please reply there. Let's keep the conversation going. We'll post a recording of this video. We'll do a little summary write up and share those as well. So thank you again to all of our panelists for being here and driving the discussion, and for all the participants. It's really awesome to see everyone jumping in and participating in the chat and in the Figma. It's been really great. And we'll be announcing some future sessions like this soon, and hope to see you there.
Everybody, thanks so much.
Thank you.
Thanks all.
Thank you.
Bye.
Max,
All right,
Cami.
thank you.
Bye.
Bye-bye.